Ladies and gentlemen, welcome back to Real Estate Investing with Alex-Deacon. My name is Adam, and I'm here with the man of the hour, the Tower of Power, Alex-Deacon, the Deacon of Real Estate. Alex, what's going on, brother?
How are you today, Adam? I'm doing great, and it's good to see you.
It's great to see you, my friend. It's been a couple weeks.
It has been, yeah. Been busy, you know.
That's good, though.
Vacations and holidays, summer stuff.
Sicknesses and all kinds of... We've had a myriad of things going on this summer. But today we're here and we're back, and we hope you guys are excited about this because we have a very interesting topic to talk about, and we want you guys to know that don't panic. A lot of people are talking about it, the market, but don't worry, it's going to crash. Yeah, the market will crash.
Absolutely.
So Alex, we can explain.
Yeah, I thought it'd be a good time to talk about it because you're kind of hearing it a little bit here and there on the news and things, and it's in the real estate world. A lot of the experts are talking about it, and I've been in the industry since '93, but I didn't know what I was doing in '93. So I guess I've been like an educated real estate person, maybe starting around maybe 2000. So. And I don't know how it, I'm not even saying I was really educated then, nor am I super educated now. I just know a lot more today than I did in 1993, right? But when I got my real estate license in 95, the market was good. It was easy to be an agent. People were buying, people were selling. So I never saw a down market till 2008. So I was just reading, we were on the internet, you and I were just looking at this. So Wikipedia says, the real estate bubble affected over half the United States. Housing prices peaked in early 2006, started to decline 06 and 07, and reached new lows in 2012. On December 30th, 2008, the home price index reported its largest price drop in history. So I guess it's between 2007 and 2009 was when the housing market really took a dump. Because it was going up in some ridiculous amount. Like I had a friend of mine who was buying condos and townhomes in like Myrtle Beach. And they were buying them pre-construction. They were buying them from a developer. Like, so let's buy 5 of them for $250,000. And then when they're done, we'll close on them, and then we'll have them sold, and we'll sell them for $300,000. That's how ridiculous it was.
Right.
I mean, how can you sustain that?
It's unsustainable.
I guess I'm not an economist, man. I don't know diddly squat about like job, the job market and what. I just don't know. I mean, I couldn't even comment on it. Even if I watch the news, when you watch the news, what do you really? You're getting what the news is telling you. You don't know how it works.
It's just a circular echo chamber.
But just think about it. Like I think about it like real simple economics. If housing prices are going up 20 and 30% in a year, even 10 or 15%, our income's going up at all. Or they might not go up 10 or 15% because it's probably not directly related on a chart or a graph or anything, but just think about it. It's just obvious. So I'm looking at the market now, and prices. Well, here in Pittsburgh, when it crashed in 2008, we never saw a huge drop in values because we never experienced the huge rise. We never had that.
That's one thing I read is that the Pittsburgh market is one of the most just not want to say predictable, but
boring.
It's boring and stable. yeah. It doesn't have as many highs and lows. It's pretty comfortable.
But now it's a little less boring. I don't know if it's the proper term. It seems like prices are going up like a lot higher than they should be. In some areas, and it's just I know something's going to happen. You have a lot of turmoil in government right now, right? You have Obama and Obamacare, which sucked, and now you have Trump in there, which he's not the greatest thing since sliced bread either. It's
so like every president, 50-50.
A lot of turmoil in there, and prices are still going up. I just foresee. I'm kind of like backing off right now as far as what I'm doing. I'm just kind of putting the brakes on a little bit.
Almost like cruise control and seeing how it plays out for a second.
Yeah, you have to. You don't know when it's going to happen. This could go on this spike right now for 5 more years.
Yeah.
But it could go on for 5 more days.
Wow.
So we had, just the reason I brought this up, and I want to talk about this thing, because me and some of my partners, we have a lot of inventory right now. So we have a lot of properties that we're buying and we want to sell them. We're not renting them out. So I don't want to get caught with 30 properties in my inventory and not have a plan B.
Right.
So my thought was let's get our inventory under control. And I always talk about the A, B, C's, and D's. So the options. When I purchase a property, I have 4 different options I look at. Option A is, if I'm flipping it, we're going to sell it and make a nice profit. Option B is we're going to flip it. Our numbers are off a little bit. We're still going to make a decent profit. Option C would be, we made some mistakes. We under budgeted. We overvalued what the property was worth after repair value. We're going to break even. Okay, so be it. The benefit of selling something and breaking even is you free up all that opportunity money.
Right.
So if you have $200,000 in a property that you can't use to go find other deals and to make a return, you're costing yourself money. So by selling it and breaking even, you're freeing up money that can make you money.
Okay.
And then option D would be, hey, let's sell it at a loss because this is just too painful financially. We need to unload it. Our opportunity costs are too great. Or you're renting it and you're able to cover your costs, or maybe even cash flow a little bit. Or maybe even you're renting it and losing a little bit each month, So holding costs on a vacant property could be a couple $1,000, $3,000 a month in this market, in our price range that we deal in. Versus if you're renting it and losing a few hundred, that's not so bad, right? So I bring this up because if we have 5 or 6 properties on the market for sale, ready to go, and they're not selling, and all of a sudden the market takes a dive, and they're just sitting there, then I want to know ahead of time, before we buy it, what can we rent this for?
Okay.
What's going to be our cost to hold it, and what can we rent it for in today's market? Because what we saw in 2008 was the house values went down, but at least in Pittsburgh, they went down a little bit, but not a lot. But the rental market was pretty strong. Because these folks, now the banks changed the way they lend money, and the rental market, I shouldn't say it was initially good at 2008, but the rental market got really strong after 2008 because the banks changed who they would lend to, and it was much harder to get a loan. Therefore, rents went up, and it was easier to keep your vacancy rate down. The downside of that is, in certain markets, there was a lot of houses that weren't able to sell, and they were renting their houses. So at some point, that rental market started to get saturated because, okay, these folks have to sell their home. They moved out of state. They can't do anything with that home other than rent it. Therefore, I might have had 3 rental properties on the market one year, but the following year there were 13 in that particular area. So what happens when there's 13 for rent versus 3?
Right. Yeah.
The prices are going to drop.
Yep.
So rental prices go up and down too.
Yeah, because it's, like I said, cost and demand, but obviously supply and demand, guys. That's the main thing with that.
So the market will crash, and I don't know. I'm just kind of. I just was thinking about it, so I thought it was a good topic. So if you, as a person who just owns maybe a couple units or just buying one, you still need to think about it like you're a big company and you have hundreds of thousands of houses, or you have to think about it that way. So even if you just have a couple homes and you're flipping one and you have one as a rental, think about that flip as it's very important to you. And what are your options? Option A, sell it. Option B, sell it for a small profit. Option C, sell it for break even. Option D, sell it, lose money. So know that before going in, because when the market crashes, and it will, you'll have that backup plan. Because you'll know based on, like I know, or I hope to know that based on my income with my other businesses and and the rental income and our flips and so on and so forth, that we could get through 2 or 3, 4 or 5 years of down economy, and still just get by.
Right.
So that's why I'm not panicking. I'm cognizant of it. Okay. And I'm preparing for it.
Now, what would, and this is just for anybody that, any new investors out there that might be listening that might not have experienced the 2008, 2009, kind of fallout, and especially because Pittsburgh has typically been as stable. What do you think has caused, and we've kind of touched upon this before, but what do you think might have caused some of the spikes in prices around here, and what might be the other side of it? Like, was it the rumors of Amazon coming in and maybe them not coming in, like with Uber, and just different things that have going on? Is it more the tech-based stuff, or is there other factors too?
Yeah, I think it's been a lot of the sizzle about tech.
Okay.
Robotics and healthcare is real big here.
Yes.
A lot of hospitals and such. But if you look at and I always revert back to this, so you've probably heard this, we talk about it, our population isn't increasing. So it's great to have, what that does is when you get maybe Uber has their headquarters here or something like that, it causes that area right around Uber probably to become hot.
Right.
And I think that's what happened. But it also but there's no increase in population.
Right,
so
exactly.
If that becomes hot over there, it becomes colder in another market. Yeah. So I don't know the numbers, but I'm just going to use like what I'm seeing, and I'm seeing like Lawrenceville, Bloomfield, and East Liberty. Those areas just blossomed. I mean, just exploded in values, and I'm seeing other areas like. And I might be wrong on this, but I see like the south side was really hot for a long, long time, and now that's kind of cooled off a little bit. It's kind of lost its sizzle, and all the sizzle and the Hollywood-esque has gone over to those other areas.
The south side works that we went down to recently, it just didn't seem, it was the first time I was ever there, and I just thought, it looks like a ghost town.
Yeah. So I could be wrong there, but I do see the housing, it's just shifting, but some areas are super hot, some areas aren't. But again, Pittsburgh the population isn't growing, so it's very stable, like 3 to 4% appreciation per year. Let's go check I'm going to check online to see what the average appreciation is.
I do think that we looked that up before. I think you might be right on that. It might be about 3 to 4 with the stability right there. So now while you're looking that up, just another quick more sort of throw at you. Say somebody was thinking about getting their real estate license, and you think that there might be a down market coming, or maybe a crash is coming. What would you say to that, that potential investor? Why would you still invest in properties?
What are you asking me? You're asking me 2 questions about an investor and getting your real estate license?
No, well, kind of like, if somebody was thinking about becoming an investor, and they hear that a down market might be around the corner, does that scare them away, or should they still?
That actually should excite them. So we'll talk about the pros of a down market, and that's why I'm kind of a little bit excited about it too. Is if you position yourself where you're financially strong during those down markets, and you don't get in over your head, and you have good relationships with banks, and you have the availability of capital, then you can do quite well. Because obviously you're going to buy properties now that are lower in price. Okay, so if the house was $100,000 today, maybe a year from now it's $92,000. That doesn't sound like a lot, but it's $92,000 versus $100,000,
and that $8,000 could be used for repairs.
And at some point you get that slingshot effect where the market is down, but then it's going to just bounce back like a rubber band, and in a short time, maybe 3 or 5 years, it could be worth $130,000.
Right.
So in 3 to 5 years, if you play your cards right and you're able to buy these with very little money down or zero money down, which can be done, and we talk about that. You've increased your wealth by a tremendous amount. So let's just say you increased your wealth by $40,000 by just buying at the right time,
right?
And 4 years later, so $40,000. If you bought maybe 5 or 10 of those houses over the next 4 years, that's $500,000.
Wow. Wow,
So
man.
and that's not hard to do. 4 or 5 homes, buying at the right time,
Right.
selling at the right time, or just holding. Because if you hold on to property, it's always going to go up. If we look at charts and graphs over the past 100 years, I think I looked at one in like the first part of this century, like housing prices didn't move. It was weird, and
Really?
yeah, I'll pull that chart up. But then since then, they just they go up, and it's average 4 to 5% according to what I'm seeing online.
Oh, okay.
Yeah.
I wonder why it became so stagnant in the early 2000s.
I think you just had a lot of people coming in from out of the country, and that was the Industrial Revolution, and there were just folks getting by. They were just living in apartments, working in steel mills, working on the farm.
Yeah.
That's probably what happened there. And now you have the Industrial Revolution and the Tech Revolution and information technology, and it's just it's different world.
Oh yeah. Oh, night and day.
It's always going to go up. Now here's something from Realtor.com carried out an investigation of the U.S. housing market in January 2018, comparing it to 1 year earlier. According to Forbes, these are general numbers and how they compare to last year's real estate market. Medium house price is $269,500. It's up 8%. Days on market 89 days, which is down 7%, which means houses are selling quicker.
Mm-hmm.
And housing inventory, 1.23 million listings, down 8%. So that means inventory is down.
More being sold. And actually, I read.
No, that means.
Yeah,
it means less on the market.
Okay.
So causing less on the market means
probably
prices are going to go up because and we're seeing that here in Pittsburgh. It's low inventory. So a good house that comes on the market that's priced right,
people are jumping all over.
It's all over. Sometimes you're getting multiple offers.
Wow, okay.
But going up 8%, that's a lot on average, right? So some areas are probably 20%. Some areas might be 1 or 2 or 3. But
and I actually read an article that millennials are now the new home buyers. They're the age demographic that's buying more homes than any other demographic. Just saying. I mean, granted, I guess generationally that should happen, but that was the generation. It was always, everyone said they were going to rent for the rest of it. You know what I mean? That was allegedly the renting generation. They're starting to buy now too. So
yeah. So the pros of a down market is if you're positioned correctly, even if you're not like thinking about buying 50 homes next year, you just want to buy 2. When that market crashes and you can buy 2 at a discount, and let's say that same $100,000 home you're getting it for $70,000. I mean, obviously it's just the lower you can get it, the better, because that market's going to go up, but. What are you going to do with it? Just because you can buy at a low price, you have to know the other side of the market is you're going to flip it. Okay, you're buying it at a low price. You can still flip it, but you're going to flip it at a low price.
Right.
Because there's still a profit margin to be made there. I think the real money is buying in a down market and holding it and renting it. And if that rental market is stable and is strong, in 3, 5, 10, 15, 20 years, your wealth will grow every year exponentially.
Play the long game.
Yeah. So I met with a woman yesterday, and I'm not a real fan on Section 8 housing.
Right.
Because we did it for a long time. We still do manage probably 40 or 50 units. Section 8, it's a bit of a hassle. It's government bureaucracy. It's dealing with the tenants. A lot of them just feel like they're owed the housing, where that's not why this was started. It was started to help you get off your, you got hurt, you get up, we help you, you go get a job, you get out of the program and let someone else get in who needs it. And you just see people take advantage of it, just like every other government program. People are going to try to go around the system and use it.
It takes one bad seed to ruin the whole bunch.
Yeah, so there's a lot of bad seeds, unfortunately, because there are a lot of good people out there that need this help. Mm-hmm. And those ones, they get a bad rap from all the ones that are they're using the system.
Yep.
But she had almost 100 units, and they rented them all Section 8. And the rents she was getting were amazing. So I think she had a great business model also. It's not one I want to take, because I don't want to deal with that element. I don't want to manage 100 Section 8 apartment houses. It's just not what I want to do at my age. It's at some point you become a different person when you turn 50. And we don't want to deal with 100 Section 8 houses. But I applauded her. I said, that is amazing. Been doing it for 12 years. She had 100 units. The rents she was getting were very, very high. And she just had it systemized. She knows what to expect. She knew the people at Section 8. She knows the paperwork. She knows the process. She knows the stuff you got to deal with Section 8 and the tenant population and what they deal with. And you can make money there. You can make money in Section 8. Absolutely. These are low-income areas. Some of them are high crime. A lot of them are higher crime. Mm-hmm. See, I don't want to be there.
Right.
But I'd never deter somebody and say, don't do that, because this lady's making a killing.
Right, yeah, right.
She is working her ass off. Her and her partner, I applaud them, because it's a lot of work, because I know. So you can make money in the down market. That might be where the real money's made. I mean, because just think about it. If she's buying in these areas that are depressed right now, what happens at the down market? That government money is probably going to stay there.
Right.
It's probably not going to be affected in any way. And if that area ever gentrifies and just explodes,
it can only go up really.
Economically, you could have a house that you pay $40,000 for, and within 10 years it could be worth $400,000. That happens. That happened over in East Liberty.
That is unreal.
Yeah. So that's the positive thing about buying in a depressed area doing Section 8 is your upside could be huge, but it is a lot of work, and you have to be able to manage them yourself and have your systems in place and have your handyman in place. You have to do all of it. You can't rely on a management company to manage Section 8 and think it's going to work. It's not. So the cons are the crash is coming. When, I don't know, but I think it's coming.
Winter is coming.
I'm kind of preparing for it, but I'm also looking forward to it because 99 times out of 10, most people aren't ready for it. Investors aren't ready for it. When it happens, people panic. When they panic, they unload at ridiculously low prices because they just went out. And that's when the smart real estate investor is in. Okay. But there's more to it than just knowing that, you know?
Right.
Like, well, I know I'm going to buy when the market's down. Yeah, that's fine. And that's absolutely where you need to buy. But you should be buying all the time, up or down. Mm-hmm. All the time. You never wait.
Right.
But buying when it's down, it's great, and that's the premise of making massive wealth, but also what do you do with that property when you buy it? Just because you have that knowledge that you buy when the market's down, there's so much more that goes to it. That's where we talk about real estate IQ and reading and learning and hanging around people smarter and wealthier and more successful than you. Mm-hmm. So when that crash does happen, you know to buy. You're able to buy because you have your capital and your banks lined up, and you know what to do with those properties and how to take care of them, how to take care of your investment. Right. So in 5 or 10 years, it's taking care of you.
Right. Basically, it sounds like a down market is almost a way that everybody makes it sound, puts such a negative annotation on it. And I don't want to make it seem like it's the greatest thing in the world, especially in some markets around the country. So if you're listening,
well, it's going to be sad for a lot of people because the average. I feel bad for a lot of folks who are buying something in an area that, like. Now, I don't know this for a fact, but I just talked to people from the West Coast, and like San Francisco is crazy high.
Right it's unrealistic.
So you buy a house in San Francisco, and then the market crashes, and their houses are cut maybe in half. That person's going to lose their house, right?
Yeah.
So I feel bad for the average home buyer because they really, what are they going to do? They have to buy a house.
Right.
If they live in San Francisco, they're either going to rent and pay crazy rent, or they're going to buy a house. The crash is the best thing to do is stay because you know it's going to come back.
Right.
But some people can't stay. They might lose their job. They might have health issues. They might have to move because of a job relocation. So those people are the ones that are really going to take a bath. It's just the way it is. It's going to happen. So.
But But so in a way though, it's not a bad starting point for people. So people that are thinking, some people might be listening to this thing and hey, real estate is kind of on my brain. Maybe I want to do this. Basically, you're saying still don't be deterred by it. Almost embrace it in a way.
Yeah, just be aware of it. Know that it can happen and it will happen, and be ready.
Be ready.
Yeah.
Preparation.
Be ready.
There we go. My friend, this was awesome. This was very, very informative. I think everyone listening will greatly appreciate this one. You excited? Now, once we publish this, it's going to be post meetup. So I'm going to ask you a question. It's going to be totally irrelevant by the time everyone listens to this. It's at your meetup on Saturday. But are you ready for tomorrow at the meetup?
I am ready.
Guys, listen.
Actually, not really. I'll be preparing tonight. First thing in the morning.
Listen, guys. Thank you so much for checking into this episode. Alex, was there any other icing on the cake you want to put on top of this one?
No, I think we covered. I mean, we could go on and on this subject, but it was something it was on top of my mind, so I'm glad we talked about it. And good. I don't want anybody to panic, but I do want them to panic at the same time.
A little bit of both. So, guys, thank you so much for listening to this episode. We hope that we made you panic, but calmed you a little bit down too, with all the talk about the market crashing and all the hyperbole that's always going around. But listen, for Alex, for everyone here at Deacon Hoover Real Estate, make sure you're checking us out on Twitter, on Facebook. Search Deacon Hoover or Alex-Deacon in any of your favorite podcasting outlets. I'm sure you will find our podcast there. Look on Apple Podcasts, Google Play Podcasts, Spreaker. We're all over the place right now. So make sure you're checking us out. And again, it's Deacon Hoover on Facebook. So for everyone here, this is Adam. Thank you so much for tuning in.